Mr. Mistry, thank you very much for joining us on our pre-budget podcast. We're having a unique budget this time because this is the first time in the history of independent India that a union budget will be presented on a Sunday. Just to get started, sir, what are your expectations from Budget 2026?
So, in my view, the budget will revolve around 5 or 6 pillars. So, let's understand what it will be. I think the first pillar will be growth, because it's critical in a country like India that we grow and grow fast, because growth will generate more investment, growth will generate more income, and that in turn will lead to more consumption and more jobs getting created. So growth, number one target. Number two target to my mind will be employment generation. So any industry which is a job machine, like for example, the real estate sector, the infrastructure sector, these are sectors which create massive amounts of jobs. Those will probably get some focus. The third will be consumption. India is a consumption-driven economy, consumption-driven domestic economy. And that is a reason why, notwithstanding the tariffs that have been imposed by the US, we've grown and grown very well so far. And actually, our growth for the year will exceed what the finance minister had targeted last year when there was no talk of tariffs. So tariffs has had a very limited impact in terms of growth. And that's largely because of the pickup in consumption as a result of the cut in the GST rates. And there are other things which can be done for consumption. The fourth, to my mind, will revolve around manufacturing. We are way behind in terms of growth in manufacturing. Manufacturing should grow and grow at a much faster pace. I remember multiple years ago, we used to have investment allowance. We used to have accelerated depreciation. So something like that could perhaps come along, which could make the manufacturing more attractive and more investments take place in the manufacturing sector. And the last focus to my mind would be the rural economy. So the rural economy has done well in the current year. Monsoons were very good, but that momentum has to continue in the coming years. So something in the rural. So these broadly will be the pillars that I would look at. And of course, some amount of capital market reforms that are required.
Right. You said that the tariffs seem to have affected, seem to have had a limited impact on the Indian economy so far. What do you think are some of the reasons behind that limited impact?
Because of two reasons. One is that India is primarily a domestic economy. We are, unlike China and unlike many other countries, we are not a very strong export-driven industry. Our exports are largely revolving around pharmaceuticals, around IT and IT services, and on gem and jewelry and textiles. So last two have been affected, two sectors, but the first two so far, touch wood, have remained relatively uninsulated. So, and in any case, exports are about 20 to 23% of our economy. And importantly, exports to the US are only about 18% of our total exports. So in that sense, the impact was bound to be a little limited. In the initial, I remember, I think in one of your channels at that time, I'd said that the impact to my mind will be not more than 20 to 30 basis points in GDP. But because the reduction, and I had also said that could be significantly offset if we were to make some reforms in terms of improving domestic consumption. And the reduction in the GST rates was exactly what the market really required.
Right, sir. How do you view the credit growth? I mean, in terms of what we're seeing over the past about 3 to 5 months, how do you analyze the credit growth within the country? What do you expect in terms of the headwinds, as well as what do you think are the tailwinds for the credit growth right now?
I think credit growth is a function of various things. We saw it's obviously a function of liquidity in the system. We were running a somewhat tight liquidity position a year ago because inflation in those days was high and RBI wanted to control inflation. Incidentally, whilst on this topic, I must say RBI has done a fantastic job in terms of managing the economy right from the COVID days. We did not have the kind of tearaway inflation that Western countries faced. We had a little bit of inflation, but nothing significant, and the economy was brought back into control very, very quickly. So all compliments to RBI. But RBI kept liquidity tight a year ago. Subsequently, in the last 12 months or around 12 months, there is fair amount of liquidity in the system. Yeah, there will be moments of time when, for a variety of reasons, liquidity may be tight. But generally speaking, liquidity has been in plenty. Buoyancy is there in the economy, and therefore people are borrowing money. The loan growth in the system, to my mind, this year will be somewhere in the 10 to 11% range, which is not very high, but it's not single digit. We must also remember that every year the base keeps growing higher and higher. And as the base grows higher and higher, your 10 or 11 or 12 or whatever the percentage is on that higher base. And therefore, in absolute rupee terms, the growth is substantial. So around 10 to 12 votes per percent. What would be the tailwind? I think the tailwind will be if the government was to do something in the budget to encourage manufacturing. And that results in a lot of factories being created, jobs getting generated, and that would then have and that could happen if you, for example, bring in investment allowance. If you remember many years ago, maybe 20 years ago, there was a concept of investment allowance, where when you bought a plant in machinery, obviously meeting certain criteria, certain conditions, then in addition to the depreciation that you would get for tax purposes, there was a one-time 25% benefit or 25% tax deduction that you could claim on the amount that you had installed, the capacity that you'd installed. It was 25 for some time, then I think it became 15, but there was a concept of investment allowance. There was also a concept of accelerated depreciation. So whilst the depreciation for a plant and machinery was, argument's sake, let's say 15%, there was an accelerated depreciation for 1 year or 2 years if you met certain conditions. So that encouraged a fair amount of manufacturing, new factories being set up, and that would also generate demand for credit. So credit offtake can pick up in a big way, and manufacturing grows.
Right. You mentioned consumption as one of the most important factors that you are considering could be addressed in budget. Last budget, we obviously saw unprecedented tax reforms. We also saw GST rate cut a little later during the year. What are some of the consumption-related measures that you think will take place during this budget, sir?
I don't know what will take place, frankly, but in my personal opinion, purely my personal opinion, I've always said this, one of the deterrents we have to fresh investment or, more investment is high tax rates, income tax rates. So if, for example, we were to cap the maximum marginal tax rate, which is currently 39.6%, we were theoretically, I'm saying theoretically, bring it down to 30%. Your tax collection, to my mind, may come down little in 1 year. But from the second year onwards, tax collection will only accelerate. One, because compliance will improve significantly. Two, because lower tax rates will incentivize more of investment, and that investment will generate jobs. Jobs will create income for people, and that income will result in people wanting to spend more money, increase consumption, and if consumption increases, manufacturers have to produce more, and therefore they have to hire more people. So you keep the economy growing by improving or increasing the level of consumption in the economy. And actually, the only way to do it is really generate employment, number one, and number two, your tax rates, whether it's direct tax or indirect tax. I would suggest direct tax. Because lower direct tax rate will significantly increase investments in the economy. And those investments will generate jobs and generate employment.
Well, one of the buzzwords online right now is the joint taxation system, wherein the ICAI has proposed that a husband and wife can, file for a joint return. Do you think that is, how do you view that from an analytical point of view? How will that impact the economy, if at all it is brought into practice, if at all that proposal is really accepted by the government?
See, we have to really understand in what form or shape it comes. If let's say a husband is working and let's say theoretically the wife is not working, the basic exemption for tax, the tax rates will have to change because now you're combining two people's income. So if theoretically one of the persons was not earning income, then to that extent the minimum slab beyond which tax will be payable will automatically increase and therefore the tax liability could reduce. But if both husband and wife are working and are earning money, which is the case today, then I don't see how it will make too much of a difference.
Okay. Mr. Mistry, you said that the tariffs, I'll bring you back to the tariffs because that's the elephant in the room. You said that we've so far not been so much affected by tariffs, but then on the other hand, we're seeing the equity markets bleeding on a day-to-day basis. What do you think are the long-term implications of tariffs, even if we consider that at one point of time they might be reversed or even the Supreme Court might just call them unconstitutional? What happens then? In the long term, what do you think is going to be the impact of the whole tariff war that has played out so far?
So for the last more than a year now, we have been seeing that foreign money has been going out of the country. You will usually find that when there is some amount of geopolitical concerns in the economy, money tends to, I'm not saying that is the reason now, but money tends to move out of emerging markets. And money moves to safer assets. And that's probably the reason why you've seen gold prices go up so significantly in recent times. But again, a driver to capital markets is valuation. Now, I'll just give you one example. It's an example. We have recently changed the labor code. So under the labor code, the wages of employees of all kinds of companies have been increased, and rightly so. Absolutely rightly so. Also, this has been done with retrospective effect. Again, rightly so. That's not a problem. The only problem is that from an accounting standpoint, the Institute of Chartered Accountants has issued a circular saying that the entire liability of the company for this, under this wage code, which could relate to liability not for 1 year, 2 years, 3 years, but could relate to multiple years, 10 years, 15 years, 20 years, 25 years of some businesses. That whole liability, that whole cost has to be charged off to the profit and loss account in 1 quarter. 1 quarter, 1 year, whatever it is. Now, what that does is artificially pulls down the profitability of Indian companies. The charge is absolutely right. You need to increase your labor rates. That's not a challenge. But the debit should not, in my view, come to the profit and loss account. We need some, if the Labour Ministry was to give some clarification, or the government, or I'm not sure who would be the right person, saying that because this is not a charge for 1 year, this is a charge for multiple years which is being taken by the company, and therefore should not be a hit to the profit and loss account of that year. It should come as out of the reserves, out of the balance sheet. Because had the higher wages prevailed in the past, then to that extent the profits of the company would have been lower in earlier years, and therefore the reserves would be low. So the right treatment, in my view, would be reserves. Now what we've done is we've reduced profits because of this. When profits go down, obviously the EPS will go down, and if the EPS goes down artificially, the price-earning ratio for Indian companies will look higher, and therefore, Indian companies will look more expensive than what they really are.
Right. So coming back to the tariffs, with this example as in mind, how do you think the tariffs will play up in terms of, in long term on the valuations as well as the profits?
So tariffs is more than tariffs, it's sentiment. And the feeling that India-US relationship is not as strong as it used to be at one time. So it's more that sentiment more than the direct effect of tariffs. If we can somehow, if that trade deal can get done, in whatever form, I think it would be a bit of a moral booster as far as equity markets are concerned.
So you think beyond sentiment, there is not much impact that tariffs are likely to have on the Indian economy?
Look, I told you 25, 30 basis points was my estimate. I don't think it will be much more than 25, 30, the way it is now. But, tariff rates can change. Products covered under tariff could change, and everything would change. The way it is today, the impact would be about 25, 30 basis points.
Okay. Mr. Mistry, one of the major concerns as a common man when we hear headlines is that the rupee is, touching a new low every month on month, day on day. What, according to you, are the factors behind the weakening of the rupee, and how is that likely to impact all our important ratios? How is that likely to impact our exports, imports? How do you view this, sir?
All right. So we still have very strong reserves, extremely strong reserves. And for a while, RBI, from whatever we see in public domain, was not intervening much in the Forex market. Usually central banks do intervene in the Forex market, not to pull the currency in one direction, but to create some amount of stability, some amount of, you don't have massive volatility going up, going down. So you smoothen out the fall. RBI has been doing this in recent times. Now, if you look at year on year, 1 year from, let's say, 1st January, or let's say 15 January, the rupee depreciation is about 5%. If you take the data for the last 20 years and see year on year what the average rupee depreciation has been, it historically has been in the range of 3 to 3.5%. Now, in that 3.5%, there will be years when it has been 5 and 6 and 7%, and there will also be years when the rupee has appreciated a little against the dollar. So it all averages out in the long term. I still believe that the 3.5-4% rupee depreciation number we've seen over a period of time, over 20 years, is probably what will continue for the next 5 years. But within that, there will be periods of volatility. Like this year might be 5% or 5.5%. Next year could be 1%, 2%, whatever it is. And the main cause for the rupee fall to some extent would be slight slowdown in exports, slight but not significant. But more than that, it's foreign money going out of the country. Now, if you want to I could make one more suggestion. A lot of funds today globally are investing not actively but passively. So they invest based on an index. In India, our index is Nifty or our index is Sensex, for example. Now, in the Western world, people use the MSCI as one of the biggest benchmarks against which they make their investments. And MSCI keeps changing the weightage of countries depending on a variety of factors. Now, the financial sector in India is by far the biggest sector in the economy in the Sensex. In the financial sector, in the banking sector, foreign ownership is capped at 74%. So therefore, the free float that is available for foreigners to invest, as per the MSCI formula, is capped at 74% minus whatever the actual foreign holding in a company is. Now, there are plenty of checks and balances in place. So it's not that any Tom, Dick and Harry can just go and manipulate the market and go and buy 5% shares in a bank or 10% shares or whatever it is in a bank. It's very closely guarded by RBI in terms of the maximum amount of shareholding any entity can have. And therefore, if you were to increase, for example, that 74% to 100%, theoretically, foreign ownership in a bank, it could, to my mind, have no impact as far as the actual shareholding goes. Because you still have the same checks and balances in place. But what it would do is it would increase India's weightage in the MSCI for the banking sector, which is again a very significant sector. Now, I don't know the number off the cuff, but to my mind, that could bring in a few $1 billion in passive money in India if this was done, without any compromise on the safeguards or whatever else.
So do you think that something in those lines is being done?
I mean, optically, I don't know whether the government would like to show 100% foreign ownership in banking. But in reality, the fact is that it has no impact on, it will have no impact on the ownership. It's only passive ownership that will go.
What about the liquidity situations for the banks, sir? Has it affected the liquidity situation for banks at large because of the overall situation that is developing, the geopolitical, the foreign outflow, plus in fact the retail money mostly going back not towards a fixed deposit but towards mutual funds? Do you think that has created a tough situation for banks to be in?
No. So let's understand. Let's be very clear. An individual changing his investment from a bank to a mutual fund or to a stock has no impact on bank deposits. Zero impact. If I'm buying a share from you, for example, I'm paying you money and you're giving me a share. Money is going out of my bank account into your bank account. So nothing is changing. As far as the banking system is concerned, the money remains within the banking system. So that is not what is affecting deposits. The only change might be the deposit may change from being a saving deposit into a current account deposit. But other than that, nothing changes. Liquidity situation in banks is a function of two, three things. One is it is a function of how much liquidity RBI allows to remain in the system. That is one reason. And the other could also be the intervention in the Forex market to stabilize the rupee or to, not let too much of volatility come in. And the third factor which would affect liquidity would be taxes. So when there's advance tax paid, the government collects the money. Now, when the government collects the money remains with the government, in the government coffers. But it will get spent. So over the next 1-2 months, that money will get spent. Once it gets spent, it re-enters the liquidity in the system. So it's a function of many factors. But clearly, liquidity from RBI has been sort of, as I said, kept liquidity tight a year ago because of fear of inflation. But because inflation has come down significantly, and we are having extremely low inflation at the moment, the liquidity situation is a lot better.
Okay. Do you think we are in a bit of a reverse inflation kind of a situation? And if
No, I certainly. You mean deflation? Absolutely not. Absolutely. I mean, one of the factors why inflation is low is because of food inflation. Food has a very large component of inflation. And because of the good monsoons, and I must say the weight of food has been stored and delivered, food inflation this year has been actually negative. So that pulls down the inflation number significantly.
Okay. If we have to really look at a post-budget scenario, I mean, wherein we are looking at the headwinds, some of the concerns that you feel the budget needs to address over 2026-27, I mean, till 27 budget, what are some of the headwinds that the Indian economy faces, which you feel the budget needs to address on February 1?
I think two factors. One is if these tariffs were to continue for a longer time, we have to continue generating domestic demand. You see, we are a young country. 2/3 of our population is below 35 years, and we have a very large number of people who pass out from schools and colleges every year. And therefore, it is critical that we create enough jobs for people when they pass out from schools and colleges. To do that, you need to get more investment in the economy. Now, that investment need not necessarily be government expenditure. It could also be money or expenses incurred by companies. So companies can spend money to expand, to create new facilities, to start a new business, to start a new factory. That requires, in my opinion, lower tax rate, improvement in sentiment, and lower GST. Slightly lower. I mean, some further rationalization of GST rates would help. Though I must say, GST rates have been significantly rationalized in the last round in September.
Right. So beyond that, I mean, the RBI has obviously done a lot of open market operations as well as currency swaps and all those things, which also have kind of helped us. But going forward, you feel one of the concerns that needs to be addressed is, of course, consumption is primarily one.
Consumption, which would generate more employment. And the second is we have to bring, this capital markets is again a bit of a concern. Like you said, so much of foreign money has gone out. And for whatever reason, if more foreign money keeps going out, we have to ensure that the markets remain stable. We don't see too much of volatility in markets because a lot of people who invested in equity in the last 4 years or 5 years are first-time investors. So they've not seen huge amount of volatility. So some encouragement to capital markets would help. Some encouragement to capital markets in whatever form, whether it's dividend, whether it's capital gains, whether it's something else, would help.
I think I'll leave it at that. But thank you very much, Mr. Mistry, for your analysis of what to expect from the budget. We are hopeful that we will again catch up with you post-budget to analyze the kind of reforms that are probably announced on February 1 as we witnessed FMC Taraman speaking. Thank you very much once again.
Lovely me talking to you. Thank you very much.